What if I told you there's a US-based EV company that's profitable, debt-light, and trading at just 2 times earnings? Sounds like a value investor's dream, right? Well, this company exists. It's called Greenland Technologies, ticker symbol GTEC, a tiny player in the industrial EV space, quietly profitable, yet trading at deep value levels. In this video, we'll not only unpack the numbers, but also judge what they really mean. So stay tuned, because this story may just surprise you. Before diving into the financials, let's understand what Greenland Technologies actually does. This isn't another electric vehicle startup chasing consumer hype. Greenland Technology builds electric drivetrains and full electric industrial vehicles. So instead of competing with Tesla, they power the companies that build America. And that niche gives them an edge. Fewer players, less marketing hype, but potentially stable B2B demand. With that context, let's now examine how this translates into their stock performance. Over the past 12 months, GTEC's stock price has quietly surged 49%. Not bad for a nanocap company, but it's still incredibly small, with a market cap under $36 million. That means the stock is largely under the radar. Very few analysts or institutions are paying attention. Combine that with a beta of 2.01, and it tells us this is a highly volatile stock, moving more than twice as fast as the market. But why is it moving? Could it be insider confidence? Turns out, 36.7% of the company is owned by insiders, including leadership. That's a strong vote of confidence. Insiders don't buy unless they believe in the business. On the flip side, only 6.2% is held by institutions, which explains the low visibility and limited volume. This opens up a unique opportunity. If institutions start noticing GTEC, demand could surge. So is the stock undervalued, or is the market right to ignore it? Let's look at the numbers, and they're almost hard to believe. P/E ratio, 1.8 price to sales, 0.34 price to book, 0.43 EBITDA, 1.0 EV free. Cash flow, 0.8. These are extreme deep value multiples. Stocks this cheap are either broken or mispriced. So the next step is crucial. Let's test whether the company's balance sheet supports this valuation. GTEC's balance sheet is surprisingly strong. Current ratio, 1.66. Debt to equity, just 0.04. Interest coverage, 383 times. They hold $20 million in cash and only $2 million in debt. That's over $1 per share in net cash alone. This is not a distressed business. In fact, they're positioned for stability, even during tough economic cycles. And that strength reflects in their ability to generate real profits. Are they actually making money? The answer is a resounding yes. GTEC posted gross margin 28%, operating margin 18.7%, net margin 18.8%, free cash flow margin 26.8%. These are not just healthy, they're excellent, especially for an industrial EV manufacturer. But what really stands out is how efficiently the company operates. With just 345 employees, GTEC generates over $240,000 in revenue per employee, around $45,000 in net income per employee. This shows a lean, high-performing team, which can often scale without drastically increasing costs. And if you're wondering how this turns into hard cash, the next section is key. GTEC brought in $82.9 million in revenue over the last year. Net income was $15.6 million, or $1.14 per share. Free cash flow, $22.2 million, almost 2/3 of their market cap. That's unheard of for a company this small. So, what are they doing with all that cash? GTEC doesn't pay a dividend, which makes sense. They likely want to reinvest in growth. There has been minor share dilution, just 1.6% over the past year. That's something to watch, but not alarming. As long as dilution stays low, investors won't get squeezed. Technically, the stock looks stable. RSI at 53 means it's not overbought, Average volume around 153,000 shares. Short interest is just 1.2%. Barely any bearish sentiment. This tells us the market isn't excited, but it's also not betting against Greenland Technologies. Which leads to the next key. What's expected in the future? Analysts expect modest revenue growth from $83 million to $87 million in 2025. But earnings per share are forecasted to grow over 70%, from 0.42 this year to $0.71 in 2026. So even if sales don't skyrocket, operational leverage could drive strong earnings growth. But remember, no story is complete without risk. There are always risks, especially with nano-cap stocks. Low liquidity equals sudden price swings, low institutional support equals limited attention, execution and supply chain risks equals higher for industrial firms. So while the financials are strong, this stock is not for risk-averse investors. But for contrarians, it could be gold. Greenland Technologies is an anomaly, a nano-cap company that is profitable, undervalued, cash-rich, efficient, and growing steadily. It's trading like a failing company, but operating like a healthy one. So the real question isn't, why is it cheap? If you found this breakdown useful, hit like, subscribe, and let me know in the comments. Is GTEC on your radar now? Would you take the risk for the potential upside? Thanks for watching Investment Matters, where numbers speak louder than hype. See you in the next one.